Hi, my name is Ben Repond. Welcome to my YouTube broadcast. Today is July 18th, 2023. Have you ever thought about how people become wealthy? Have you ever thought about or researched how people start from nothing, very meager, modest beginnings, and become wealthy, become billionaires or multi-billionaires? Some do. There's a thought process that goes on with people like that. And as I was researching it, I've studied the FIRE movement quite a bit. And as I researched it, I came across Mark Cuban. And most of us know of Mark Cuban, and the owner of the Dallas Mavericks and host on Shark Tank. But he has a career in investing in all kinds of businesses. He's a finance guy and he's a business guy. And there's a lot about him. I would say if you have not read his biography or even just the piece on Wikipedia, it's very interesting about his background. He truly came from nothing. His family had nothing. His dad was a working class guy, and then his journey went through college and then tending bar and then building some software and just looking for opportunities and making the best of those opportunities. And then things worked out very well for him, but not because he didn't take some risk, and he didn't, and not because he wasn't innovative, because he certainly did take risk, and he certainly was innovative. So I want to play just a very short piece here about Mark Cuban and how he became wealthy, and then after he became wealthy, how he looked at money. And he says this thing, I just think it's so interesting, and he still looks at it this way. You can see his conviction on it. He does live, a very good lifestyle, but he says, in becoming wealthy, he said, whatever you make, whatever money you make, making more money and more money, live like a student. Live like a student. And he did that. Now, of course, he's wealthy and he doesn't live like a student, but he has that mindset. So I think if he ever had to, he could live like a student very quickly, and he describes how he did that. But the reason I'm playing it is because it's kind of at the core of the FIRE movement, financial independence, retire early, kind of at the core of that, where people live very, very frugally, unbelievably frugally, and save a substantial amount of their income. And becoming wealthy oftentimes is not about how much money you make, it's how much money you spend. And so he goes through that, and I think he's a good example of what today is considered the FIRE movement. So take a listen to Mark Cuban.
When I was researching for this, I'd come across that you'd read a book called How to Retire at Age 35.
Yep.
And it kind of reminds me of like today, do you know the whole FIRE movement, financial independence, retire early people?
Well, that's the same thing. Yeah, exactly.
Yeah, all these people now who are like engineers, they save money, they retire at 30 and live off ramen.
Yep.
So it sounds like you were the first one.
That's exactly right, man. Live like a student. Live like a student. If I could save $100,000, interest rates were a lot higher then, right? So, if I could save $100,000 and live off of, 50, five, whatever it was, right? $10,000, 100,000, 10% interest rate. So $100,000 went $10,000 a year, right? So if I can get up to $250,000, then I'd have $25,000. Could I live off of that? Yeah, back then I thought I could live off of it. And that was my orientation, save up enough so I could retire and live like a student.
But what I find fascinating is like, what drove that psychology? Because you seem like someone who loves to work, loves to build things. So why do you care about retiring?
Just because the way I was raised, my dad really didn't have his own time to himself, right? Every morning, he was at work or leaving for work at 7 a.m., 6 days a week. He got home at, noon or 1 on Saturdays, and that was half a day off. We loved to take vacations, but he was always at the beck and call of somebody else. And he would always instill in me, the most valuable asset you can ever possibly have is time. And to me, and he always liked to say, today's the youngest you'll ever be, live like it. And to me, just being able to just own my own time, like until I got an iWatch, I hadn't worn a watch in 30 years. The day I sold Micro Solutions, I took off my watch and said I'd never wear a watch again, because that signified I have to be somewhere and pay attention to time that other people set for me, right? And to be on someone else's schedule. And so never wore a watch again until I got an iWatch. And that's why, I just want to be able to do whatever I want, whenever I want, however I wanted to do it. And I got really good at it.
Next, CNBC anchor Melissa Lee interviews Steve Eisman, and he was the investor in The Big Short. And he talks about in his firm, an investment firm, I think it's a hedge fund, of how they were somewhat defensive last year. And while they are still somewhat defensive, they've kind of shifted over to some offense. I don't know. He doesn't give any detail, but just reading between the lines and the way kind of his facial expression actually is, it tells me that probably his firm had a 15% loss last year, some kind of a loss, not horrible, but something like that. And then maybe this year they have maybe a 10% rate of return. I don't know, because it's private, but just he was really hedging his answers on that last year and this year, and knowing what people have told me and what I've seen people experience, that would kind of fit somewhere. In other words, they got it a little bit right. It wasn't horrible, but they did not shift very quickly into this year. And I probably were considering that they needed to be fully invested last year, because a lot of investment firms look at it that way. They have to be fully invested. So they could be invested in more defensive type stocks, but it still lets them be invested. And we don't do it that way. We do tactical. So if there's too much risk in the market, or risk starts to enter the market, we get out of the market. And when that risk diminishes, we get back in. Not a phased in or phased out approach. Either we're in or we're out. That seems to work for us. I'm not being critical of him. It's just he gives a kind of an answer that says that a number of people got it wrong this year, because leading up to this year was so dramatically different than this year has become. So take a listen to Steve Eisman.
Let's get to Steve Eisman. He is known, of course, for predicting the '08 housing market crash. And now Big Short investor Steve Eisman is questioning the market's rally stamina just as earnings season is about to get started. He joins us now. Steve is now the senior portfolio manager at Neuberger Berman. Steve, it's always good to see you.
Thank you for having me.
What do you make of the markets? We're sort of all, scratching our heads a little bit. The volatility in the bond market, the rally we've seen in tech.
I think everybody, including me, has underestimated how much institutional investors were underinvested at the beginning of the year. Everybody was, as one of my partners likes to say, this is the most anticipated recession that so far has never happened. And so people are chasing. It's starting to feel a little manic, but could go on quite a bit longer, because as long as the economic data is okay, I don't see why people are going to sell their stocks.
It's funny when an institutional investor says that the thing that you got wrong was underestimating how much institutional investors have been invested in the market. Were you also underinvested? I mean, were you sort of bracing for something really terrible to happen? And do you still believe that it will happen? Or are you saying, things actually look much better?
Well, I think we came into the year fully invested. We did better last year than the market because we were somewhat defensive. We're not quite as defensive as we were. But I would admit that I'm surprised about how much the market has gone up this year. I really am.
Are there shorts in the tech sector then if things look manic?
I don't talk about individual stocks, but thanks for asking.
Well, in the sector itself.
I think it's too hard.
Bubble.
It's too hard. I mean, even stocks where I think the companies are not even going to last. The correlations between all these companies that have very high revenue growth and negative earnings is almost 1. So it's not really stock picking, it's like group picking. Last year those stocks were all down 75 to 90%. This year they're up like 40 to 50%. But when you go from 160 to 10 and now you're 14, looks good on a percentage basis, but it's not so good if you've owned it long term.
So now I'm going to give the alternative view. And I play Mike Wilson a lot. He's very smart. He's from Morgan Stanley. And he believes very firmly with a lot of data that we are going to enter a recession. Not a typical recession, but an earnings recession, where earnings will come down, and as a result, that will probably put the brakes on the economy, and it will probably put the brakes on the stock market and possibly the bond market. So that, with a surging first half of the year in equities, not bonds, but in equities, that seems improbable. But he's done his research, and so he says sometime in the next quarter or two. This would be third quarter following the second quarter earnings and fourth quarter following third quarter earnings. So I think it's interesting. I happen to put a lot of credibility in Mike Wilson. I think he's very credible. And so I would say take a listen to this. It's the alternative view, and this will add to the other things that I am playing.
Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, July 10th at 11 a.m. in New York, so let's get after it. With year-to-date U.S. equity returns driven nearly 100% by higher valuations, the market either doesn't care about earnings or it expects a major reacceleration in growth both later this year and next. One might argue that the higher valuations are anticipating the end of the Fed's rate hiking campaign, even though the bond market doesn't seem to agree with that conclusion given the recent rise in yields. In short, the price-earnings ratio for the S&P 500 is up approximately 15%, and with interest rates up this year, the equity risk premium has collapsed by 100 basis points to its lowest level since the tech bubble era. With second quarter earnings season beginning this week, better than feared likely isn't going to cut it anymore. While earnings results so far this year remain right on track for the sharp earnings recession we forecast, we don't expect second quarter earnings to disappoint expectations in aggregate, given second quarter estimates have now been revised lower by 7.5% since the beginning of the year. Instead, we would point out that the consensus bottom-up second quarter EPS forecast for the S&P 500 is negative 7% year over year. Hardly exciting. Furthermore, the consensus pushed out the trough earnings per share growth quarter from the first quarter to the second quarter over the last 3 months. We expect this trend to continue through the balance of the year, which would also be in line with our forecast. In other words, no big second half recovery as the consensus and valuations now expect. More specifically, third quarter is when our forecast starts to meaningfully diverge from the consensus. This means the key driver for stocks during this earnings season will come via company guidance for the out quarter rather than the second quarter results. We suspect some companies will begin to walk down the estimates, while others will continue to tell a more optimistic story. In short, this earnings season should matter more than the prior two, and should provide significant alpha opportunities for investors in terms of both longs and shorts. In our view, the year-to-date multiple expansion has occurred for a couple of reasons beyond earnings growth optimism. One, excess liquidity provided by global central banks amid a weaker U.S. dollar and the FDIC bailout of depositors. And two, excitement around artificial intelligence potential impact on productivity and earnings growth. On the liquidity front, we think that support is starting to fade. One way of measuring liquidity is global money supply in U.S. dollars. One of the reasons we turned tactically bullish last October was due to our view that the U.S. dollar was topping. This, along with the China reopening and the Bank of Japan's monetary policy actions, added close to $7 trillion to global money supply over the following 6 months. We've pointed out previously that the rate of change on global money supply is correlated to the rate of change on global equities, as well as the S&P 500. Over the past few months, global money supply in U.S. dollars has begun to shrink again, just as the Treasury begins to issue over $1 trillion of supply to restock its coffers post a debt ceiling resolution last month. As an early indicator that market liquidity is fading, nominal 10-year yields broke out last week above the psychologically important 4% level, and real rates are making new cycle highs. Interest rate volatility also picked up as uncertainty about the Fed's next moves increased. Neither higher interest rate levels nor volatility are generally conducive to higher equity valuations. Bottom line, with earnings season upon us, we aren't expecting any fireworks from the earnings reports directly. However, with expectations for growth now much higher than 6 months ago, we suspect it will be a sell the news event for many stocks, no matter what the companies post, as the market begins to look ahead to what is likely going to disappoint lofty expectations.
Last Friday, July 14, University of Michigan Sentiment Consumer Confidence Index came out, the score on it came out, and this is Rick Santelli I'm going to play, and his reaction to it as it comes out live. And it was a very, and as he will say, a very positive number. So the consumer is feeling very positive right now, generally speaking. Now, each person is a little different, so they do a survey of a lot of people and then come out with this index, and and it has a lot of credibility. So if you're looking for the alternative view to Mike Wilson's alternative view, this would be the positive side that says this is why the market is moving up, tends to be moving up. However, at these levels, the stock market, at these levels, the market is starting to struggle. It's having a hard time going up from here, although during the first 6 months, you could say, with the exception of February, it was a very positive period for equities. But so take a listen to Rick Santelli's reaction to the Consumer Sentiment Index number when it came out Friday morning.
Welcome back to Squawk on the Street. Rick Santelli here live at CME HQ with the last breaking news of a busy week. University of Michigan, our July preliminary read. Expecting a number around 66, 72.6, 72.6. That's the best since September. If we look at current conditions, 77.5, and that is the best since October of 21. And if we look at expectation, what lies ahead, 69.4, 69.4. That's the best going all the way back to July of 21. So these are powerfully strong numbers.
I don't think I've ever played anything or featured any person on that came from Shark Tank. And today I'm featuring two, Mark Cuban and Kevin O'Leary. And so I saw this article that where he was interviewed, and his comment about the U.S. economy, and he looks at, he's an investor. He runs an investment firm. I think they're a private equity firm, and they invest in small businesses, and small meaning under 500 employees typically. And one of the things that's very important as a private equity fund is the cost of capital and the availability of capital to invest in small business, because that is so significant for our economy. Most of the jobs come out of small business, and so if there is a slowdown in the economy or slowdown in investment in small business, it will slow down that growth and be a significant impact on the economy. So I think from his perspective, running this investment firm, this is a private equity, maybe it's venture capital. I think I'm not sure which, but it's an indication of maybe some storm clouds out there that we are not yet seeing, because small business, the indicators on small business are not front and center to us every day. So in the interview, I'll just read a brief piece of what he said here. He said this, or the article said this: although the U.S. economy has seen some respite from record inflation, Kevin O'Leary from Shark Tank warns there is a crisis emerging for U.S. small businesses. And then I'm quoting him here: I live in the real world. I'm in Washington talking to everybody I can about the problems I've got in just getting working capital for small businesses. We have a crisis emerging. O'Leary explained that small businesses will find it increasingly difficult to finance growth. These rapid rate hikes that have occurred have put my small businesses, the ones his firm invests in a very difficult, and I'm talking about companies with 5 to 500 employees, which represent over 60% of our economy, If you're in the S&P 500, you have no trouble financing your business. You can't say that about small business anymore. The cost of capital has gone through the roof. There's no cash for small businesses. And when the Fed raises rates another 50 basis points, as they say they will, that's going to make it worse. No, I'm not happy, says Kevin O'Leary. We have seen this year the surge in artificial intelligence and artificial intelligence companies, and the stock price of those companies, the most notable which is NVIDIA, but there are many others, large companies as well as small, who are investing or working on the development of technology in the AI space. So I thought I would, and I've had conversations with people about investing in AI companies. Now, you know from my philosophy, we're cautious, and I am personally cautious. So I don't invest in high flyers. That is not my style. So when you see stocks that surge up, 50%, 100%, 200%, the inclination by people is to get on board. And there is the emotion called FOMO, fear of missing out. And I need to get on board because I don't want to get left behind. And that reminds me a lot of the late 1990s, particularly 1999, when stocks were surging, .com stocks were surging. A few of them made it. Most of the rest went bankrupt. And but it reminds me of that. And so what I thought I would do, and I've had this conversation with many people, is I come up with rules, guidelines, that if I were an investor, if I were tempted to invest in this, these are the guidelines I would put on myself. And when people want my advice, these are the things I tell them. I'm not giving you investment advice and telling you what to do. You can do whatever you want to do. This is just guidelines that I would apply to me if I had that question. So I'm going to go through these and comment. The first one is be prepared for a very rough ride. You may see this period right now that we're going in where AI stocks in particular go up and up and up and up. And every day you look at the internet and the stock is up again, just day after day, week after week. That doesn't look like a rough ride. But there is coming a time where it will be a rough ride. That may be a deep decline. It may be a decline and then a surge up and another decline, a lot of head fakes, and not by just a few percent, but by huge percentage moves. This drives people crazy. So the most investors are not looking for that. And when they see it moving up so quickly, they don't think about, oh, this is going to be a rough ride. They think, oh, I could get rich, or look at all the people who've already gotten rich, and so forth. And they want to get on the bandwagon. The second suggestion or guideline is don't buy at the top. So right now, we are at the top or near the top on a lot of AI companies, AI stocks. The temptation is to buy here. And so that is not what I would recommend. I would recommend that someone who's interested in that, wait for a period of time, be patient, and wait for that stock to pull back. You set your own guidelines of where you want that to be. I would have some guidelines if I were to do it, but I'm not going to give financial advice out over the internet. But I would say just wait for some kind of a pullback and for that to be, an entry point. Limit your total investment to 5% of your available liquid dollars. So your investable dollars, whatever 5% is of that, limit it to that. And I would call this speculation money. You might even call it gambling money. then I'm going to roll the dice. And if this works out, great. If it's not, I don't risk too much. I'm only going to put 5% at risk. It allows you to get in the game, to play in that sandbox, so to speak, but not become too overweight in something that volatile and that risky. So you may think, just like in 1999, well, this is not risky because of fill in the blank. And or it was true in 99, but it's not true now. This time is different. Who said that? John Kenneth Galbraith said that. He said the 4 most dangerous words in the English language are this time is different. And it usually never is. It's a little bit different, but the result, generally speaking, is similar. I would say diversify with at least 5 stocks. Don't just go into one. And if you want that to be 10, you could have it be 10 or whatever number. But some kind of diversification, even though they may be all in the AI space, create some kind of diversification if this is what you're looking for. And then I would say hold your positions for at least 5 years. If you don't look at it every day, some people look at their accounts frequently, some people very seldom. I would say put this in the category of put it away, put it in a drawer, lock it up, and come back and look at it later, and don't worry about it. And those would be, I think, if you follow those guidelines, if you're interested in this, it's the way I would personally do it. AI turns this single bullet point into a long email I can pretend I wrote. And she says, AI makes a single bullet point out of this long email so I can pretend I read. It goes both ways. So yeah, I think AI is here to stay. I think it has a lot of applications. I think many of them probably good, but like a lot of things, it can be used poorly as well. But hopefully this is of help to you. Thank you for watching. If you have questions or comments, leave them in the comment section below.